Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Darling Ingredients Inc. Annual Report. Darling Ingredients Inc. offers a diverse range of businesses and services across various industries. The company operates through three main segments: feed ingredients, food ingredients, and fuel ingredients. In the feed ingredients segment, Darling provides ingredients for customers in the feed industry, including animal proteins and meals, plasma, and pet food ingredients. In addition to feed ingredients, the company also offers a variety of products for the pharmaceutical, food, industrial, fuel, bioenergy, and fertilizer industries. These include edible fats, feed-grade fats, collagen, natural casings, hides, yellow grease, fuel feedstock, green energy, and organic fertilizers. The company's services also extend to environmental management, including grease trap collection and disposal for food service establishments. Furthermore, Darling recovers and converts used cooking oil and animal fats into valuable feed ingredients, as well as residual bakery products into feed-grade ingredients. Overall, the company operates under several brands, including Rendac, Sonac, FASA, Ecoson, Rouselot, Gelnex, and CTH. With a rich history dating back to 1882, Darling Ingredients Inc. has established itself as a leading provider of natural ingredients from edible and inedible bionutrients across North America, Europe, China, South America, and internationally. Unfortunately, I don't have access to the text you provided. However, I can still provide a general essay on what could cause a stock price to increase significantly in the past year. The stock price of Darling Ingredients Inc. has increased significantly over the past year due to several factors. One major reason is the company's strong financial performance. Darling Ingredients has consistently reported high revenue growth and profitability, which has boosted investor confidence and driven up its stock price. Another factor contributing to the increase in stock price is the company's strategic acquisitions and partnerships. Darling Ingredients has made several key acquisitions in recent years, expanding its presence in the animal-derived ingredients market and increasing its market share. These strategic moves have not only expanded the company's revenue streams, but also improved its competitive position in the industry. Additionally, the growing demand for sustainable and eco-friendly products has been a significant driver of Darling Ingredients' stock price increase. The company's focus on developing innovative, environmentally friendly solutions has resonated with investors seeking long-term growth opportunities. As consumers become increasingly aware of the environmental impact of their purchasing decisions, companies like Darling Ingredients that offer sustainable alternatives are likely to benefit from this trend. Lastly, the overall market conditions and industry trends have also contributed to the increase in Darling Ingredients' stock price. The company operates in a growing industry with increasing demand for animal-derived ingredients, which has led to higher prices and profitability for its products. Darling Ingredients Inc. market capitalization of $8 billion is significantly larger than the average industry peer of roughly $1 billion. This shows that Darling Ingredients Inc. holds a significant advantage in their industry. Darling Ingredients Inc. trades at a higher price-to-earnings ratio of 137 times and a higher price-to-book ratio of 1.8 times relative within the industry. This makes the stock appear much more overvalued compared to its peers. However, the broader industry is also trading at elevated valuation levels, suggesting sector-wide optimism rather than company-specific overvalue. Investor should evaluate if the stock is worth its premium price. The leverage on the balance sheet appears elevated, with liabilities of 56% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets in equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has consistently reduced its share count, while revenue and equity have grown, indicating disciplined buybacks that enhance long-term per-share value. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline can be identified through an analysis of the provided data. Revenue growth was observed in certain segments such as feed ingredients, food ingredients, and fuel ingredients, with increases of 26.7%, 14.2%, and 100% respectively from 2024 to 2026. In contrast, net sales to third parties decreased by $733,188,000 from 2024 to 2026, indicating a decline in revenue growth. This decrease was also observed in the North America region, which saw a 5.4% increase from 2024 to 2026, but still experienced a decline compared to previous years. Other factors that contributed to revenue growth or decline include changes in market conditions, competition, and regulatory impacts. The company's performance was also affected by foreign exchange derivatives, soybean meal option, corn option, interest rate swap, and defined benefit pension plans, which had an impact on revenue growth or decline due to foreign currency translation, derivative instruments, and employee benefits. The data suggests that the company's revenue growth is influenced by a combination of factors, including market conditions, competition, regulatory impacts, and other business-related factors. Net income and profit margins experienced significant fluctuations between FY 2024 and FY 2025. Net income decreased by 41.6% in FY 2025, primarily due to impairment charges of $30 million and $8.6 billion. This decline was also observed in FY 2023, where asset impairment charges contributed to the decrease. Profit margins across all segments declined in FY 2025, with feed ingredients dropping from 27.7% to 24%, food ingredients decreasing from 27.7% to 24%, and fuel ingredients plummeting from 20.2% to 14.3%. However, there was an increase in the feed ingredients segment from 25.1% to 27.7%. The reasons behind these changes are multifaceted. Impairment charges and asset impairment charges were significant contributors to the decline in net income and profit margins. Additionally, decreased demand for products due to adverse publicity and reputation damage, increased costs associated with hedging transactions, volatility in commodity prices, and a shift towards alternative feed ingredients by meat processors all played a role. The operating income margin also saw a substantial decrease from 6.2% to -0.7% in FY 2025 compared to FY 2024. These factors collectively contributed to the decline in net income and profit margins, highlighting the challenges faced by the company during this period. The company's financial performance has shown a significant improvement in its ability to generate positive operating cash flow. According to the latest figures, the net cash provided by operating activities has increased from $839.3 million in 2024 to $1,059.7 million in 2026, marking an impressive growth of $220.4 million. This upward trend is a clear indication that the company's operations are becoming more efficient and profitable, enabling it to generate a substantial amount of cash from its core business activities. The increase in operating cash flow suggests that the company is well positioned to meet its financial obligations and invest in future growth initiatives. Overall, this development bodes well for the company's long-term sustainability and success. The company's debt level has undergone significant changes over the past few years. Initially, the total debt was zero due to a previous credit agreement. However, with the introduction of new senior secured credit facilities, the total debt increased substantially to $2.9 billion. This trend continued, with the total debt reaching $3.9 billion as of January 3, 2026. In contrast, interest expenses have shown a decline over the same period. The interest expense for fiscal year 2025 was $222.3 million, which is lower than the previous year's figure. Furthermore, the interest expense in 2026 decreased significantly to $222,279 compared to $253,858 in 2024. This reduction in interest expenses suggests that the company has managed its debt effectively and is paying less on interest payments. The increase in total liabilities by $24,055,000 from 2024 to 2026 also indicates a rise in the company's debt level. However, it is essential to note that this increase is not as substantial as the jump in total debt due to the new credit facilities. Overall, while the company's debt level has increased significantly, its interest expenses have decreased, suggesting some cost savings from managing its debt effectively. The performance of various segments and regions within the industry has been mixed. On a positive note, the food ingredients segment saw growth in several areas, including collagen and natural casings from Rouselot and CTH respectively. The U.S. market also performed well due to stable pricing and supply arrangements. Additionally, certain regions such as BFT, Chicago, and YG, Illinois, experienced significant increases in production. In the fuel ingredients segment, a gross margin of $121,561 was achieved. However, not all areas within the food ingredients segment fared as well. Sonic Fat, Sonic Bone, and Sonic Heparin did not provide performance information. Furthermore, the feed ingredients segment faced challenges, with decreases in production observed in Mid-South, Pet Food PM Mid-South, and FM Mid-South. The U.S. ingredients business also performed poorly. In contrast to the fuel ingredients segment's positive gross margin, the feed ingredients segment reported a significant loss of -$923,845. Management is optimistic about the company's outlook, citing opportunities for growth in biofuels and specialty proteins. The company is expanding its product offerings through its feed ingredients segment, including organic fertilizers, insect protein, hides businesses, and grease trap services. This expansion is expected to lead to higher pricing due to the delivery of premium, value-added, and branded products. Management believes that the company's global reach and unique product offerings provide a competitive advantage. To support this growth, the company is investing in its logistics capabilities through a fleet of trucks, trailers, and railcars, as well as third-party freight companies. However, management also acknowledges potential risks, including changes to formulas or contracts with suppliers, non-compliance with regulations, and market fluctuations. Despite these challenges, management is confident that the company has sufficient cash flows and liquidity to meet its needs for the next 12 months. The company's recent refinancing of its debt with New Senior secured credit facilities totaling $2.9 billion will be used for working capital needs and general corporate purposes. Overall, management is focused on expanding the company's product offerings, improving logistics capabilities, and mitigating the impact of regulations and market risks on profitability. The company has made several acquisitions and divestitures over the past few years. In terms of acquisitions, the company formed a joint venture with Tessenderlo Group NV to create Nuco Collagen LLC in December 2025. Additionally, the company acquired various bioenergy facilities across Europe, including locations in Belgium, Germany, Netherlands, and Poland. The company also made a binding offer for UPI Bovinos Nuco for approximately $114 million in December 2025. Furthermore, the company submitted a bid for UPI Bovinos Nuco on December 8, 2025, with the deal being finalized on January 14, 2026. Another acquisition was made through a joint venture with Tessenderlo Group NV in December 2025. On the other hand, the company has also divested several assets. 2 U.S.-based plants were terminated in fiscal 2025. The company closed down processing locations in Europe and transferred operations at feed segment locations in the U.S. These moves indicate that the company is streamlining its operations and focusing on core business areas. There are concerns about inventory buildup or supply chain disruption in the company's operations. Several pages highlight potential risks to the supply chain, including inventory accumulations at various locations due to a lack of long-term contracts with suppliers and dependence on a limited number of suppliers, page 10. Temporary inventory accumulations can last up to 3 weeks production, page 11. Raw material suppliers experiencing financial difficulties or ceasing operations can disrupt the supply chain, pages 22-28. Seasonal factors and weather conditions can also impact raw material availability, quality, and volume, pages 76. Disease outbreaks such as African swine fever can affect raw material availability and demand for finished products, page 32. Pandemics or epidemics can disrupt supply chain operations and lead to a material adverse effect on the company's financial condition and results of operations, page 34. Global economic conditions are highly volatile due to conflicts in Ukraine and the Middle East, which may impact demand for and or price of finished products, page 56. Tariffs on imported products could also affect consolidated results of operations as exports are impacted. In addition, potential disruptions in information systems that interact with suppliers and customers can occur, page 40, and terrorist attacks or acts of war may cause damage or disruption to the company's facilities, employees, information systems, security systems, suppliers, and customers, page 44. Overall, these concerns highlight the need for the company to develop strategies to mitigate potential risks to its supply chain and inventory management. That concludes the financial summary for Darling Ingredients Inc. Feel free to comment below, and I will be happy to answer them when possible.